Hello everyone, today is 30th April 2025. Over the past month, global markets have been shaken by heightened uncertainty surrounding President Trump's new tariff measures and the pressure he has placed on the Federal Reserve. These developments have ushered in a period of significant volatility. As the U.S. president has since moderated his stance to allow for dialogue, market sentiment has somewhat stabilized. However, investors remain deeply concerned about the outlook for the U.S. economy. Despite the turbulence, global equities, including emerging markets, posted gains of nearly 1% in U.S. dollar terms, lagged European markets, which were up to 4%. However, this performance was driven by currency effects, as the U.S. dollar continued its decline, falling around 5% over the month. Meanwhile, oil prices dropped 15%, reflecting growing concerns about demand and a potential oversupply risk following OPEC+'s decision to increase daily production by 411,000 barrels starting in May, nearly triple the expected amount. As dollar weakness and trade negotiations allow for EM currencies to appreciate, the yield curve has been narrowed in most EM markets, except for China. Mexico has been a key winner, delivering 11% of performance in dollar terms, of which almost half is currency-driven. Korea and India both rebounded at around 6%. Key ASEAN markets and Brazil were up by 4%, while China, Taiwan, and Saudi were among the laggers, affected by more uncertain trade prospect and tech demand, as weak oil prices respectively.
Soon after announcing reciprocal tariffs in April, the Trump administration paused them for most countries, but raised them on China. What could this mean for emerging economies?
So far, significant uncertainty remains over the trajectory of trade policies and the extent and timing of their impact on the global economy. In the first quarter, U.S. GDP contracted by 0.3%, following a 2.4% increase in Q4. While China's manufacturing PMI fell to 49, its lowest level since December 2023, signaling the first signs of real economic strain. This uncertainty weighs heavily on export-driven emerging markets such as Vietnam, Malaysia, and South Korea, as well as developed economies like Germany and Japan. Adding to the volatility, President Trump's public criticism of the Federal Reserve Chair has further eroded investor confidence, contributing to U.S. dollar weakness. As U.S. exceptionalism wanes, pressure on emerging market currencies and capital outflows has started to ease. In this shifting landscape, countries like India, Mexico, and Vietnam are emerging as potential long-term beneficiaries of global supply chain realignment. India, in particular, appears well-positioned due to its large, domestically driven economy, the benefits of lower oil prices, and the prospect of a near-term U.S.-India trade agreement.
What supports your constructive view on China, given that it's been a key target of U.S. trade actions?
Trade-related uncertainties have created a notable headwind for China's exports, a key growth driver in the previous year, with export cargo volumes down 10% year-over-year in the first 25 days of April. We believe these pressures will prompt Beijing to adopt further policy easing to mitigate the impact of tariffs. In light of the weakening April data, we expect an acceleration in government bond issuance and see a high likelihood of another reserve requirement ratio cut. Looking ahead, policymakers are likely to calibrate stimulus measures to support the GDP growth target of around 5%. Encouragingly, corporate fundamentals remain resilient for now, with earnings momentum broadly stable. We continue to find selective opportunities in China's technology and industrial sectors attractive over the mid to long term. Moreover, the country's relatively low valuations versus other emerging markets may already reflect a degree of macroeconomic risk. In May, 2 of our portfolio managers will travel to China for on-the-ground due diligence. We aim to deepen our understanding of both macroeconomic developments and company-level dynamics, and we look forward to sharing our insights in post-trip reports.
How do you position your portfolio in this environment?
Quality growth stocks with exposure to domestic demand remain at the core of our portfolio. GEM Equity has allocated 33% of its assets to China, compared to 30% in the benchmark, reflecting our constructive view on the Chinese technology and automation sectors. Latin America accounts for 13% of the portfolio versus just over 7% in the index, with Sabesp, the Brazilian utility company, standing out as our largest regional holding at around 5%. We also maintain a slight overweight in India at just above 20%, where Indian financials represent a key conviction, comprising 12% of the fund. Taiwan remains an underweight, making up 14.4% of the portfolio. Our most significant underweight continues to be the MENA region, which represents only 1% of our holdings compared to nearly 8% in the benchmark. We sincerely thank you for your continued interest and trust.